If you're a tax pro, you know the offer-in compromise can sometimes feel like you're just plugging numbers into an IRS machine, right? But the real magic, the wins that make a huge difference for your clients, well, they happen when you learn to beat that formula. So today, we're going to dive into some advanced strategies that'll help you turn that rigid calculation into a real negotiation.
I want you to really let this sink in. This is the mindset, okay? That first number the IRS throws at you, that initial rejection letter, that's not the end. Not even close. It's just their opening move. And a smart negotiator, that's you, can use the right tactics to turn that no into an amazing win for your client.
Okay, so the IRS has this formula, right? They use it to figure out what they call a taxpayer's reasonable collection potential, or RCP. But here's the thing. That formula, it's just the starting line. It is not the finish line. In this explainer, we're going to walk through 3 real-world case studies that show you exactly how to push back, how to reframe the conversation, and, get way past that initial number for a much, much better deal. All right, first case up. And this one tackles a super common trap, seeing the lowest number on the page and just assuming, yep, that's the one. We're going to look at a client named Brian. He owed a ton of money, and his case is a perfect example of why you've got to dig deeper. Okay, so here's the deal with Brian. He's on the hook with the IRS for $186,000. Now the formula spits out 2 options. You've got the lump sum right there at $88,400, or there's the periodic payment plan, which totals up to almost $139,000. I mean, looking at this, it's a no-brainer, right? Of course you take the cheaper one.
But is it? Is it really a no-brainer? That's the $88,000 question. You can't just look at the final number. You have to ask a much more important question. Where is that money actually coming from? Because trust me, the cost of getting that money can totally change the game.
So here's the playbook. First, you got to figure out the funding source. Is it a loan, cashing out retirement funds? Step 2, you calculate the true cost of that funding. We're talking interest, penalties, fees, all of it. Then you add that cost on top of the offer amount to get the, you guessed it, the real cost. And only then can you really compare apples to apples. Now for Brian, he was going to get a loan from a partner to make that lump sum happen. And that loan, it had an 8% interest rate. The periodic payment, though, he could just cover that from his regular cash flow. No loan, no interest. And here's the reveal. Look at this. Once you tack on that $7,200 in loan interest, the real cost of that lump sum suddenly jumps to over $95,000. Now, okay, in Brian's case, the lump sum was still the better deal, but look at how much that gap closed. That massive $50,000 difference, it's way smaller now. And you can imagine for another client, this kind of cost could absolutely flip the script. So the big takeaway here, you have to model the real cost of funding every single time. Okay, let's move on to case number 2. This is Sandra. And her situation, well, on the surface, it looks completely hopeless. The IRS formula says she can pay every single penny of her tax debt back. 0 savings. This is exactly where most people would give up. But it's also where we need to start thinking outside the box, beyond the usual doubt as to collectability argument. And this right here, this just lays it all out. The debt is $94,000. Her calculated ability to pay, $94,000. It's a wash. And like I said, for a lot of folks, this is game over. You pack up and tell the client, sorry. But that's only if you think the only reason for an OIC is that someone can't afford to pay.
And this, my friends, is the game changer. It's called an Effective Tax Administration, OIC, or ETA for short. An ETA offer isn't about can the client pay. We already know Sandra can. It's about whether it's fair or right for the IRS to force them to pay, given their specific life circumstances. We're not arguing about numbers on a spreadsheet anymore. We're making an argument about equity.
So here's what we did. We built a case. See, Sandra had a very serious medical condition, and that so-called ability to pay was completely dependent on her being able to spend $2,800 a month on medical care that was literally keeping her going. So we documented everything. We got letters from her doctors, we submitted treatment schedules, copies of the bills, the whole thing. And our argument was simple but powerful. If you force her to pay you in full, she can't afford her care. Her health will fail, she won't be able to work, and then you won't get any money. And the result? Absolutely incredible. The IRS accepted an offer of just $42,000. That's a 55% savings for a client who, remember, looked like she had 0 chance of getting a deal. It's just proof positive. When the numbers don't work on collectability, you have got to look at the ETA basis. It can be a lifesaver. Okay, on to our third and final case. This is Raymond. And his story is all about something you're going to face all the time, a rejection from the IRS. But remember what we said at the very beginning? A rejection isn't a stop sign. It's not a dead end, especially if there are errors in it. Then it's an open door.
So check this out. We put in an offer for Raymond for about $38,000. The IRS comes back, rejects it, and counters at almost $68,000. That's a huge gap. So what happened? Simple. The IRS specialists messed up the math. They made a bunch of mistakes, and now our job is to find those mistakes and fight back.
And we found him. Here's what they got wrong. First, they valued one of his properties at full market value when the rules clearly say you have to use the lower quick sale value. Big difference. Second, they took his single best month of income and acted like he made that every month, instead of using the required 12-month average. And the biggest one, the real kicker, they completely ignored the fact that the clock was about to run out on a big chunk of his debt. The CSED was right around the corner. Now, this is why the CSED, the collection statute expiration date, is your best friend in these negotiations. See, just by filing the appeal, we paused collection, but not the CSED. And while we were in the appeals process, poof, the statute for one of the tax years expired. $34,000 of his debt just disappeared. The IRS literally lost the legal right to collect it. Talk about leverage. We had them over a barrel. So, armed with the correct math and that CSD leverage in our back pocket, we went back to appeals. The final outcome? They accepted an offer of $51,600 on what was left of his debt. What a turnaround. We took a flat-out rejection and turned it into a huge win, all because we saw it as the start of the fight, not the end.
So what have we learned from Brian, Sandra, and Raymond? It's more than just a few neat tricks, right? It's a whole framework, a repeatable strategy that you can bring to every single OIC case that crosses your desk.
Let's put it all together. Step 1, model the real cost. Just like with Brian, you have to account for the price of funding an offer. Step 2, evaluate every basis. If can't pay doesn't fly, pivot to shouldn't have to pay with an ET argument, like we did for Sandra. Step 3, appeal every error. A rejection with bad math isn't a no, it's an opening bid. That's the lesson from Raymond. And finally, step 4, leverage the CSED. An expiring statute is the most powerful tool you have.
So at the end of the day, it really comes down to this one question. Are you just a calculator or are you a strategist? Look, anyone can fill out the forms and plug in the numbers, but a real pro, an advanced practitioner, that's someone who sees the formula as just the starting point of the conversation. When you model the real costs, when you explore every angle, and when you see a rejection as an opportunity, that's when you start getting the kind of results for your clients that a simple calculator could never even dream of.